Hello friends. Friends, we are going to continue with ratio analysis, right? So in the last lecture of ratio analysis, we started with solvency ratios, right? And in the solvency ratios, we started with the debt to equity ratio. Debt to equity ratio, that is the relationship between these two terms. One is debt, the other is equity. Right? Debt to equity ratio describes the relationship between debt and equity. What is debt for the business? It is the money borrowed from outsiders. This is borrowed funds. What is equity? Equity is owner's funds. Right? So, you borrowed the money from an outsider and invested in the business, that is your debt, because you have to repay that money. Right? And if you have your own funds, that is known as equity. Clear? Then we discussed about debt. How to calculate debt? There are basically two formulas. One is long-term borrowings plus long-term provisions. Right? This is one. The second is out of the total debts. I told you when we talk about the debt equity ratio or we talk about the solvency ratios, we will always talk about long-term analysis. Right? So, if we talk about the debt here, we will only consider the long-term debt. So, out of the total debts, if we remove current liabilities, we are going to get the long-term debt. Clear? So, this is how we are going to calculate debt. Either we will use long-term borrowings and the long-term provisions, or we will deduct current liabilities from total debts. This will depend upon the information that is given in the question. Right? Then second part is equity. For equity, the one way of calculating equity is share capital plus reserves and surplus. Right? Share capital is the money that is invested by the owners, right? And reserves and surplus is like profits or money set aside out of profits, that is reserves. So the profits belong to whom? The profits belong to the owners. So it is considered as equity. Clear? Second way is total assets minus total debts. This is another way of calculating equity. The third way is, I will break this formula only. What is total assets? Non-current assets plus current assets. This is total assets, and I will subtract total debts. Total debts is long-term debts plus current liabilities. This again will depend upon the kind of information that you have in the question, that which formula will be used for calculating equity. Clear? So this is what we discussed in the last lecture in detail about The debt means the borrowed funds, equity means owner's funds, right? What is a debt? It is a long-term borrowing plus the long-term provisions. We will get the long-term debts, because when we talk about the solvency ratios, we always talk about the long-term analysis of the business, not the short-term. Clear? So when we talk about equity, I have share capital and the reserves and surplus, or I can say total assets minus total debts, right? Or I can further break this formula of total assets and total debts into non-current assets plus current assets minus long-term debts minus current liabilities. Clear, friends? Right? Now, let's do some practical problems on this. Very simple. From the following information, calculate debt to equity ratio. Share capital 10,000, equity shares of 10 each, 1 lakh. General reserve 45,000, surplus, that is balance in the statement of profit and loss 30,000. Then you have debentures of 75,000, long-term provisions of 25,000, and outstanding expenses of 10,000. So what we are going to do is, again we will divide it into two parts. One is equity and the other part is debt. Clear? Equity is own funds, share capital, we have 1 lakh rupees. Yes, share capital is of the money invested by the owners of the company. So we will consider this as equity. I'll say share capital 1 lakh. Clear? Then journal reserve, yes, because it is the amount that is set aside out of profits, and profits belong to whom? Profits belong to the owners of the company, right? So journal reserve 45,000, yes, we will consider it. Journal reserve of 45,000. Then it says surplus, that is balance in the statement of profit and loss. What it means? It is nothing but your profit, and profit belong to the owners, 30,000. So your surplus is 30,000. Now, next, debentures 75,000. It is always a long-term investment, right? So it is a debt. $75,000. Long-term provisions of 25,000. This is what we are using. Long-term borrowings plus long-term provisions. Right? Long-term provisions are 25,000. Long-term provisions of 25,000. Right? The last we have outstanding expenses. See, if you are given only outstanding expenses, then we will consider it as a short-term liability, because outstanding expenses for the very small expenses that will be cleared within a period of 12 months. These are not, the long-term expenses. These are the short-term expenses, right? So outstanding expenses is the short-term liability, so we will not consider it while calculating the debt equity ratio. So here we have equity of 1,75,000 and we have a debt of 1 lakh rupees. That means we have own funds of 1,75,000, whereas we have borrowed funds of 1 lakh rupees. The business is doing superb. Why? Because we have own funds. Our dependency on the borrowed funds is less, right? That is why we calculate this debt equity ratio, right? Debt divided by equity. What is debt? 1 lakh. Equity is 1,75,000. So this comes to 0.57:1. This means that business is growing at a very good rate because the dependency of the business on the borrowed funds is less, and the business is using more of its own funds. Right? It's a very good sign for the business. Clear? Let's move on to the next problem. From the following information, compute the debt to equity ratio. Shareholders fund, equity share capital 2 lakh, reserves and surplus 1,50,000, long-term borrowings 10% debentures 3,50,000 and current liabilities of 1 lakh. Very simple, right? So you have equity, you have debt, right? It says you have equity share capital of 2 lakh, it belongs to the owners, 2 lakh rupees, it is equity. So we have share capital of 2 lakh. Then you have reserves and surplus of 1,50,000. Again, it is the owner's money. Reserves and surplus 1,50,000. On the other side, you have long-term 10% debentures of 3,50,000. 10% debentures of 3,50,000. Then next you are given current liabilities. Will you consider current liabilities 1 lakh? Will you consider current liabilities while calculating debt to equity ratio? No, because we will only consider the long-term debts here, the long-term liabilities. So that's it. So you have an equity of 3,50,000. 3,50,000 debt. So what is the debt equity ratio? Debt divided by equity, 3,50,000 divided by 3,50,000, 1:1. That means we have equally invested own funds in comparison to the borrowed funds. Right? We have equally invested own funds as compared to the borrowed funds. And in the last lecture, I told you the appropriate debt equity ratio is up to 2:1. Beyond that, it is a danger sign for the business and as well as for the investors whose money is at stake. Right? Even up to 1:1, it is perfectly fine. Right? Your dependency on the borrowed funds is equal to what you have invested your own money. Clear? So the debt equity ratio here is 1:1. Clear? Let's move on to the next problem. From the following information, compute debt to equity ratio. Long-term borrowings 5 lakh rupees, long-term provisions 1 lakh. Surplus, that is balance in the statement of profit and loss, debit balance 1 lakh rupees. Debit balance means it is a loss. It is a loss of 1 lakh rupees. Equity share capital 2 lakh, general reserve 2 lakh. Right? Again, we'll make two columns, equity and debt. The first point, long-term borrowings 5 lakh rupees. Long-term borrowings 5 lakh. Right? Then the long-term provisions of 1 lakh. Long-term provisions of 1 lakh. Clear? Now talking about equity. Equity share capital 2 lakh. Right? The next we have general reserve of 2 lakh. This also belongs to the owners of the company. Now, what is to be done with this loss. If you have the profits belong to whom? The profits belong to the owners of the company, and if there is a loss also belongs to the owners of the company. Who will bear the loss? The owners of the company will always bear the loss. Right? They are the contenders for the profit, and they are the contenders, they will share the losses. So in case of loss, what will happen? Your share capital will reduce, your equity will reduce, not share capital, your equity will reduce. Right? Loss of 1 lakh rupees. Right? So this comes to 3 lakh. This comes to 6 lakhs. What is the debt equity ratio? Debt divided by equity. 6 lakhs divided by 3 lakh. 2:1. Clear? This is considered to be an appropriate debt equity ratio. Their dependency on the borrowed funds is double the amount that is invested by the owners. It is considered to be an appropriate, but even if it is less than this, it is very good for the business. But if it goes beyond this ratio, if the debt keeps on increasing, that means your dependency on the debt, on the borrowed funds, is more than your own funds. Right? Then even you are at risk, and the persons who have invested, who have lended you the money, investors in your business, they are at a very high risk. If your debt equity ratio is high, then your investors are at a high risk. Clear? So friends, this is about the debt equity ratio, the relevance of debt equity ratio, why we calculate debt equity ratio, to identify the long-term position of the business, right? To identify whether business is dependent more on the borrowed funds or the own funds. This is very important. Clear? So that's all for the debt equity ratio, friends. So in the next lecture, we'll move on to the next ratio under the solvency ratios, that is assets to debt ratio. Right? And if you have any queries, friends, just send me an email at ksjteaching@gmail.com. Right? So that's all for this lecture, friends. Thank you so much.